Thank you for joining us. I'm Gord Long. As is always, it's my pleasure to have back with me this morning Charles Hugh Smith, well-known and prolific writer on the web, who is the publisher of the well-recognized website of2minds.com. Welcome back, Charles.
Thank you, Gordon. It's always my pleasure.
I trust you had a great summer. We haven't, as many listeners may know, you and I took a summer sabbatical from doing these, and it was nice. For me, anyway. I hope it was for you.
Yeah, other than that 40 inches of rain that fell during Hurricane Lane here in Hawaii, but we survived that.
Finally, I don't feel sorry for you being in Hawaii. You always make me feel bad. But we did a lot of sailing, so I feel really good about this summer. Charles, let's just jump right into this because we always seem to run out of time. And I don't think our listeners want to hear our stories on our summers. But I'm showing here our agenda for this session. And as we agreed, I'll be taking the lead today for our newer viewers. Typically, one of us will take the lead and the other will just interject so that we can get through the materials. I'm showing here the agenda that we're planning on going through today. But the focus today is on really how sustained easy money has seriously, and in my opinion, dangerously distorted the global supply chain overall. Now, this slide I'm showing here is an illustration that we put together back in 2012, Charles. You see the bottom with the copyright? And we were talking about that back then, in that period. And we were warning then about the central bank policies and where they were potentially taking us and what we thought might possibly unfold. And if you look at the end, it's exactly what's happened, and it had happened maybe even as much as 2 years ago. And each of these steps were predictable. And it's not that we were that smart. It was just that when you get off sound money and you start to print money in excessive amounts, it causes unintentional consequences. And that's what really we're talking about today, is one of these unintentional consequences. We additionally laid out what the emerging market problems would eventually be after, a little later on. I did a couple videos called the Echo Boom, and they were in 2013 and 2015. And I'm showing it here, the key chart from that, saying that, look, all this money's going into the emerging markets. Here's what it's going to mean, but it's going to come back like an echo. And when money starts to get tight. And this is the destruction that it was going to do across the emerging markets as money got tight, rates went up, currencies fell, but fell for the wrong reasons, in that it wasn't to make them competitive. It's just because their current accounts were in trouble, and they were being forced to increase interest rates, which caused other kinds of problems. And how I felt at the time that it would flow back into the peripherals problems of Europe, who've lent to the vast majority of emerging markets. So we laid all of that out, and as I look at this chart here, Charles, it says at the bottom, it says the Fragile Five. The only thing I can find that's different today after all these years is last week I saw an emerging markets debacle. They're referring now to them as the Sorry Six. So not much change in all those years. Any comments so far?
Yeah, thank you, Gordon. I just want to mention that that this series that you've been discussing, and you reminded me that we did our first program on the global supply chain problems about 3 or 4 years ago. So we've been monitoring this, and what we're trying to do here, which is I think unique in the investment economic universe, is to tie together these concepts which are typically just looked at in isolation, which is the global supply chain, corporate debt, currency issues and valuations, and overcapacity, and the pressure on profit margins. And when our previous program, we showed, we discussed that when you make money nearly free and easily available to corporations, they're going to first invest in in increasing their product flow, right? So that means overcapacity is now a global issue. There's too much of everything, right? And so that's pressuring profit margins, and it's also created a huge amount of debt, and that's really the core issue that I think you've been pinpointing in your work, and that we're gonna explain again in this today's program.
Precisely. I have up a chart here called Creating the Distortion, and it springboards from what you just said, Charles. Like, what distortion are we talking about in the global supply chain? And the things that we were isolating before, and what we were arguing. And this is the benefit of us doing these shows for quite a numbers of years. We have reference points. But what we were arguing was that quantitative easing was fundamentally about increasing demand. And it was increasing demand by lowering financing costs for other various reasons. But by doing this, what it did is it brought demand forward. It didn't create new demand. It just allowed demand that was out there to be pushed forward because of lower interest rates to buy things. The consumer had more money available through credit, and that's why credit exploded. It's not that their earnings were more, they just had access to money to create the demand. The obvious problem with this is that it obviously creates a demand hole, resulting in a slowdown in the outer years, or at least you should expect to see a slowdown coming because of the demand that you brought forward. I mean, maybe it'll sustain a little bit and have a delta growth, but there's a hole. And that's exactly what's happening today in the emerging markets around the world. Is global trade is slowing down. The IMF is warning about it. The OECD is warning about it. The Bank of International Settlement. The only one that's not warning about it is Wall Street. But clearly, there's a global slowdown in trade. I didn't say profits or earnings, but the slowdown is happening in trade, and that's to be expected. But what isn't fully appreciated, what I just said, is that quantitative easing consequentially and obviously increased supply, and that's your point. Because if there's more demand, there's going to be more supply to match it. But all this supply came in. Not only now do we have this whole excess of this whole lack of demand, but everybody, because of cheap money, got into the businesses and overcapacity, overbuilt. Even if the demand had stayed, it would have been overbuilt. But now we've got this dropping off in demand. So cheap central bank money allowed the global build out in production capacity. Overcapacity resulted in, as you also point out, lost pricing power. So suddenly, right now, and that's what we're starting to see, they're having to and have been slashing prices because their fixed costs are there, and their financing expenses are going up because they borrowed in U.S. dollars. They either close up shop or they try and get enough sales at any price to at least cover their basic costs, forget the profits. And that's the hole that's been created. So countries in emerging markets, their negative current accounts, those that have had negative current accounts, which have exploded higher, are now having their currencies absolutely crushed. And weak currencies have forced the central banks, as I said earlier, to increase rates. And what's happening, therefore, is and I'll show you a little later, that we've got this creating a new wave of zombie corporations in the emerging markets, because they're to just simply survive, or they're seeking government relief as if the government can help them. And I could go into a whole discussion on Turkey. Comments there, Charles?
Well, let me just ask you, Gordon, to define or describe what a zombie corporation is, because new listeners might not be familiar with what that actually means.
Yeah, I think good point. Sorry, Charles, and I didn't explain that because it's just not a term that's catchy. And what a zombie corporation is where your profits are less than your interest expenses, to be really simple. There's some netting and everything else. So in other words, you don't make enough money to cover the interest expenses for the equipment and materials and ongoing cash flow to run your business, and your cash flow is not supporting it. So you're trapped into having to borrow more money. Now, if you're borrowing more money and interest rates are going up, your problem's getting worse at an exponential rate, correct? And
Yes.
and so I'll show just in a second here just the degree of zombie corporations that have been created, because people like the Bank of International Settlement, who are screaming about this, actually this month put out a full extensive paper just specifically on zombie corporations. But I have this chart, Charles, to show you that what's different this time in the supply chain and emerging markets. We always go through problems with emerging markets every few years, but this time it's right around the world, as shown on the right. Every single emerging market country is their currencies this year have absolutely collapsed, which, by the way, happens to mirror the compression in the rate of liquidity growth, interestingly enough. And on the left, it shows that this was predictable, because these were all countries, the little grid of the circles is countries with very large negative current account rates and and GDP as a percentage of their current account. So they were problematic, and now they've hit, and their currencies are getting absolutely killed here. Now, as I said, well, back off on that. The debt growth we've talked about has been growing at a phenomenal rate, but the onus and the discussion always seems to be about consumer debt and government debt. And no question, it's through the roof in all categories. But in red, this is corporate debt. The real hidden discussion that nobody's having is corporate debt has exploded around the world. We recognize it in America and we talk about it, but we always say it's because they're floating bonds to do the buybacks. $3.5 trillion worth of buybacks and another trillion this year. The money that didn't come out of just interest, free cash flow, it came out of borrowing money through the bond market and debt offerings and leverage loans. But it's more than just buybacks, which has primarily been an American-centric, to a large degree, problem. This is around the world, and it gets into all of the emerging markets who've exploded their debt. And this chart here just isolates the emerging markets and the growth in corporate bonds in emerging markets. And you can see it's just been straight up, not quite exponentially, but it's straight up. And it's a massive hidden debt that's compounded on the problems that we were just talking about. And I mentioned, I'd say what Bank of International Settlements is doing. This is their figures are showing that over 10% of global corporations are now zombies. And that's where EBIT, in their case, not EBITDA, but EBIT is smaller than their interest rates. But over 20% of global firms are now considered challenged. So they're being able to handle it, but they're questioning whether it's really free cash flow, et cetera. But their numbers are dated here. They're not even current. So there's a significant and growing number of these, both of these particular categories right now. Now, if interest rates go up, and they are going up in these countries because their currencies are falling, and to keep the money coming in, they're having to increase their currencies, or their interest rates. So even in the local currencies, these countries are getting killed on the interest rates, but they've borrowed in US dollars, and the US dollar continues to strengthen for those who follow it. Comments there, Charles?
It's a great way that you've described how this zombie corporations are the epitome, if you will, or the manifestation of monetary malpractice and malinvestment. And so let me just kind of walk us through that. Is that when the central banks made money globally very cheap and very available, then at that time the US dollar was weak. And so if you're a corporation, you go, gosh, I can borrow all this money at 1 or 2 or 2.5%, 3%. Let's just borrow $1 billion or $2 billion and we can play around with it. We can expand production, or we can buy back our shares. And so that's part of why global debt and corporate debt has exploded. Is it was so easy and cheap to borrow. Now what's happening is the secular trends have reversed. The US dollar is strengthening, which means that you have to sell, more of your local currency in order to get dollars to pay your interest in that's due and payable in dollars. That's running against you now. Interest rates are rising around the world. That's now a tide that's running against you. Now global trade is slowing, then your sales are plummeting. So you see how these secular trends toward less liquidity, higher interest rates, dollar strengthening or dollar shortage, however you want to call it, and falling trade and sales. These are absolute killers. There is no way out of this. So you can try to refinance, but you're going to be doing your existing debt. But every time you roll it over, it's at a higher rate of interest, which only puts you deeper into the zombie status.
Exactly. They put it into perspective. Well over $9 trillion was borrowed by emerging markets that was denominated in U.S. dollars, and all of their currencies are falling like rocks and have been as the U.S. dollar strengthens. 9 trillion. And if you say that the central bank's balance sheets have grown by over 20 trillion, that puts it into perspective. So the emerging markets, the cardinal sin is you never borrow in a currency that's increasing in value. You borrow in a currency that's going to be weaker. And as you point out, the U.S. dollar a few years ago was considered weakening, right? But this is just a bad management. But in these emerging markets, they're fighting to grow. And the other part of it, Charles, is they're lower in the value add chain. So they're feeders. They're making components or they're making commodities that are being sold up into the value chain, for example, into China that's doing the manufacturing. So they have much less leverage on pricing. They've not just on the volumes, but just in their ability to push their prices up a little higher. The products can be moved anywhere. In a bat of an eye, you can change countries on a lot of these various component manufacturers. But as you are component suppliers, but it's a little bit more difficult as you get into the higher levels of manufacturing. And as you well know, with, for example, the iPhone at when it was $360, now it's $1,000. But at $360, China was only making $6.70 a phone, right? And if you go through the supply chain around the world, where all the value was, and you start to get into all these various components in the assembly products around the world, and then of course the commodities to supply them.
Yeah, and Gordon, I want to interject here that you have a wonderful chart where the chart ties in the emerging market debt to the European Union based banks, and I think it's important to go back. We touched on that, but here's the thing: the crisis begins in the periphery, which in this case is emerging market corporate debt, but it comes back to the core because the core is the lenders, and so as defaults start falling and increasing, it's like a domino chain of dominoes falling, and that chain of dominoes will lead right to the core banks, and they will be basically rendered insolvent.
Precisely.
And nobody wants to talk about that.
Well,
so what do we do then?
They're going to be forced, and they're being forced right now. Actually, I have 2 videos out, part 1 and 2, on exactly this, called Turkey, Emerging Markets, and the European Banking Crisis 2. And that's the sequence, because this is the problems in the emerging markets are all going back to Europe, because the biggest and it's the right word that you used, peripherals, because the 2012 banking crisis in Europe was about the peripherals. We actually use words like pigs, right? If you recall those, right, Charles, which were the peripherals,
Yeah.
and that stood. I apologize, but that's what it was used. We had to change it around. Pig stood for Portugal, Italy, Greece, and Spain. And that's where the problems were in terms of lending. And why those countries? Because if you go to South America and all the emerging markets there, you'll find they primarily borrow through Spanish banks, Portuguese banks, or Italian banks. You go around the world and you'll find various European countries have dominant banking in various of these emerging markets. So, but all of the debt is pretty well goes back to Europe. And Europe is a much more leveraged financial system than the U.S. because it's a wholesale-based system, and so then of course it's also a euro dollar based problem. So separate from even though they were lending the money in U.S. dollars, being European banks, not necessarily in the euro at the time. So these banks, there's without question, the problems we're seeing in Italy are only the beginnings, and the problems in Italy aren't reflecting emerging markets fully yet. They're reflecting this whole problems that are fundamental to the EU. That is, not staying within budgets, insufficient growth in productivity, and the peripheral countries not being able to compete.
Right. And, Gordon, one of your charts here you brought back from our April show, Are Trade Wars Inevitable? And the charts labeled Tariffs and Trade Wars Are Inevitable. And you have zombie corporations boxed in red. Right above there is the key dynamic we're talking about. Debt growth larger than economic growth. And that's really what the core context of our whole conversation here is corporations have borrowed immense sums of money, but that hasn't really driven economic growth. It's the debt growth, and the debt service has grown far faster than the actual economic growth, which was the intended goal of monetary stimulus, right? And so what it hasn't created economic growth so much. What it has created is a vast expansion of debt, and now the debt service is going to create what you call a death spiral.
Yes, we again, as you said, this is a chart we put together talking about why trade wars were inevitable and where they're going to lead. But all of this, as you're also pointing out, it overlaps. You can see where it's all feeding off itself. And if you look at the growth in debt, and now that debt not being able to sustain economic growth, when all the money was being borrowed by the governments and the consumers, our productivity wasn't growing at a sufficient rate. So what happened was, for every dollar of debt we were creating, we weren't getting $2 and $3 of growth. We started where we were barely getting $1. Then we went negative, okay, in terms of what that debt was giving us. But it's even more complicated than that, because I've got up here a chart showing the growth in corporate debt. Global corporate debt has went from 74 trillion to 54 trillion in the last 5 years. Global junk rated companies is up 58% since 2009, and a vast amount. If you look at investment grade debt, over half of it's now triple B, which is one notch above junk. And if we have any slowdown, those will be downgraded. They fall into junk, and most pension plans and insurance companies can't have them in their portfolios. They got to jettison them. Can you imagine how quickly that problem would grow? But back to the bigger point here is, because it's corporate debt right now, they haven't been able to deliver the productivity that debt should have been, and translating it additionally into GDP at a country level around the world. It was just frankly, it was just malinvestment. It's money that's not going to be returned to them, because the technology cycle is so short today. Your factories themselves are being obsolete. It's not like you jump on something else. Your whole supply chains are changing. So it just can be a tremendous a collapse potentially. And remember, Charles, no matter what, they will print the money, right? The only way out of this is to dramatically get away from quantitative easing, go to some form of quantitative easing, helicopter money, drop interest rates probably down into negative rates to try, but next time it won't work like it did last time. That's another show to talk about. But just show the amount of leverage. I have a chart here, Charles, in the high yield, showing the debt to the EBITDA versus the spreads. And so what's happening is the leverage has just been, it's going up at a faster and faster rate. So I was saying earlier, the debts, you look at straight line emerging markets, but if you look at the leverage, it's going exponentially to keep them temporarily alive. That's the definition of a zombie, is when that starts to go exponential. Comments?
Right. And so, you have a chart here that leads us through the conclusions,
Hmm.
and I'm not going to take them point by point, but I just want to comment that this the crisis you're describing here is in the private sector. It's corporations which borrowed way too much money and which cannot really support that debt, and so they're going to have to default, and that those defaults are going to wipe out trillions of dollars, and those are going to come back to the losses of the lenders, which are, as you say, largely banks in the EU. But because the global economy is now so linked, you can't have a crisis that's just in China or the EU and the US. And this is what we learned in 2008 and 2009. Once you get a debt crisis where liquidity dries up and there's huge losses to be taken, it spreads like wildfire through the entire global financial system.
The word counterparty risk is going to be a very common word in another year from now. And governments can print money to bail themselves out, and to some degree the consumer, which is what we did as a single country with a single problem. That was the housing collapse in 2008. And you correctly point out, this is a global problem in every country, and printing the money and trying to get it out there is not the same this time. And because this whole supply chain's is going to be reset, and there's tremendous unintended consequences of what quantitative easing did, and that's what we're trying to summarize here. But there's more than just this, unfortunately, Charles, of unintended consequences for quantitative easing. I'm not trying to preach doom and gloom here. I'm we're trying to really stress what to look for, because the famous guy that called the last collapse, and he wrote the book on the Big Short. He's actually specifically saying the same thing as I am right here. He's saying, hey, the next big issue is in corporate, and it's because it's global. And I have no idea what he's doing from an investment standpoint, but pay attention to high yield credit spreads and watch the credit cycle would be my advice for everybody out there. Any final closing comments, Charles?
Yeah, Gordon, I hope we'll pick up the thread on this in future programs, because one of the unintended consequences is horrendous inflation in the emerging markets. Because when your currency loses 40% of its value in a few weeks, that means that your oil and gasoline, which is priced in dollars, just got 40% more expensive.
Precisely.
And,
We have not had price inflation. We've had asset inflation. We're going to see price inflation. And minimally, if nothing else, just the trade wars themselves, which seem to be intensifying, at least with China. Remembering that when you put a tariff in, as we have in the United States, it's actually a tax. We're the one. The prices go up on our end, and we have to pay higher prices. So it's a tax on us. It's not a tax on China. It hurts their supply to us because they've got all the problems we now talking about in the supply chain because of volumes, and people aren't going to buy as much. But we're going to buy a product at a lot more money, and that money's going to the U.S. government. By the way, Charles.
yeah,
I think
and
you understand what I'm saying there. And if I did some back of the envelope, and the amount of money that would be taken in if some of these tariffs go through in the United States comes very close to the money we relieved in the last tax bill that we just passed. I'm sure it's just a coincidence.
right. So my last comment, Gordon, is let's keep an eye on these zombie corporations, because they are going to close. There's the amount of pain required to keep zombie corporations afloat. It's not worth the pain, and so there's going to be defaults, and there's going to be losses on a monumental scale that are going to have to be absorbed by somebody.
I just hope it's nobody that's listening to us who have investments in some of these, right, Charles? But we don't give investment advice here. We just
No.
lay out the economics of what we see, because you never know what the governments will do individually as groups, and policies. And one thing we do know, they will change policies, they will print the money, and they will change the rules. They will change accounting rules. Remember make to market or mark to market? Never did come back, but that's how we got us out of the last financial crisis, right? We just changed how they could do the accounting on their books, changed the bank's whole structure. Well, there was others, and we actually did a show on that, right, Charles?
Right.
But they'll change the rules. Insurance companies are already, pension plans have now been authorized to change some rules because the pensions are in trouble. So we'll change the accounting rules. We'll end up buying the market, stock market with money for Swiss banks doing, Bank of Japan's doing. So you can't just jump to conclusions with as bad as some of these points we've made, because you don't know which rules are going to be changed in policies. Have to run. We have to close, Charles. So unless you've got anything else, I'll talk to you next. Actually, maybe next month or the month after. We're not sure yet.
Yep. Looking forward to it, Gordon. Thank you very much.
Talk to you again. Bye bye.